The strange thing about the U.S. stock market right now is that it looks calm on the surface, almost peaceful in a way that feels completely disconnected from everything happening in the real world. While ordinary Americans are stressed about rent, groceries, shrinking paychecks, and rising debt, the stock market behaves like none of it matters. The indexes still climb. Tech giants still break records. Investors still talk confidently, as if nothing is wrong. It's the kind of eerie calm that only appears right before something big happens. The quiet moment when the sky goes still before a storm finally breaks. And that's the unsettling part. The numbers are steady, but the feeling in the air is not. Americans are tightening budgets, skipping small luxuries, cutting trips, delaying purchases, and bracing for something they can't fully describe. Yet the market continues rising like it lives in a different country, untouched by the same pressures millions feel every single day. This disconnect isn't just unusual, it's a warning sign. Because in history, major corrections rarely happen during chaos. They happen during confidence, when everyone believes the worst is behind them, when the system looks unshakable, when optimism becomes a blindfold. Right now, that blindfold is everywhere. People see their portfolios going up, or at least holding steady, and assume that means the economy is healthy. They see their retirement accounts recovering from past dips and assume stability has returned. They hear analysts on TV talking about strong fundamentals and market resilience, and they assume this is just another cycle that will sort itself out. But deep down, even investors feel the tension. They know something doesn't add up. They know the U.S. economy can't struggle this badly on the ground, while the stock market floats upward like a balloon disconnected from the string that used to tie it to reality. They see companies reporting revenue increases while at the same time laying off workers. They see stocks hitting new highs while grocery prices hit new records. They see corporate profits rising while consumer confidence collapses. And they don't want to ask the uncomfortable question, how long can Wall Street ignore Main Street before everything snaps? This calm market is not a sign of strength. It's a sign of delay. A pause before impact. A moment where the system stretches itself just enough to give people a false sense of comfort. The market looks stable because it's balancing on a fragile foundation of low-volume trading, hopeful speculation, and algorithmic buying that reacts to headlines more than it reacts to real life. It's like watching a glass table hold more and more weight, looking perfectly fine right up until the moment it finally cracks. And just like that table, the U.S. stock market right now is holding more weight than it should. Overvalued companies, over-leveraged investors, unrealistic expectations, and a flood of retail traders who jumped in during the last few years believing the market can only go one direction. The problem is that no market in history has ever stayed detached from real-world conditions forever. Eventually, the pressure of everyday life, the household debt, the shrinking purchasing power, the business closures, the layoffs, the rising costs, eventually drags the market back to reality. And the signs of that reality are everywhere, even though the market hasn't fully responded to them yet. People are spending less on things they don't need, which will hit earnings soon. Businesses are slowing hiring and preparing for leaner months. Banks are quietly tightening their standards because they can see what's coming. Households are running out of savings and turning to credit just to get by. None of this matches the calmness of the market. It's like watching waves slowly build, while the shoreline pretends the water isn't rising. The disconnect itself is the biggest warning of all, because every major correction in the past started with this same kind of calm, this same sense of everything looks fine, this same feeling that the worst is behind us when, in reality, the real danger is forming right beneath the surface. The market isn't rising because everything is strong. It's rising because it hasn't caught up to the truth yet. And that truth, the pressure building in households, the strain on businesses, the tightening credit, the fading confidence, is getting too big to ignore. The calm before the impact always feels peaceful, almost comforting. But it's also the moment when people let their guard down, unaware that the first crack could appear at any second. And when it does, the entire market will finally have to face the reality it's been avoiding. What makes the current stock market even more unsettling is that beneath the glossy surface, there are red flags blinking everywhere. Signals so obvious, so loud, so historically dangerous, that it's almost shocking how confidently Wall Street keeps pretending they don't exist. One of the biggest warning signs sits inside the heart of the tech sector, where stock prices have soared far beyond what real-world earnings can justify. Some companies are valued at levels that make sense only in a fantasy economy, not the one Americans are actually living through. Share prices keep climbing while revenue growth slows, customer spending declines, and future guidance quietly weakens. It's a dangerous illusion. Investors pouring money into stocks because of hype, brand power, or momentum, not because of actual financial strength. And this kind of overvaluation is the exact pattern that shows up before major corrections, when companies look untouchable right until the moment they suddenly aren't. But tech isn't the only issue. Corporate debt has ballooned to levels that should terrify anyone paying attention. Companies are borrowing heavily just to maintain operations, refinance old loans, or fund buybacks that artificially inflate their stock prices. Stock buybacks have become a tool to make weak companies appear strong, creating the illusion of growth even when earnings aren't improving. Instead of investing in workers, innovation, or long-term stability, corporations are buying their own shares to manipulate optics. It's a house of mirrors, a financial trick that works only when interest rates are low and consumer spending is strong. But rates are high now, and spending is shrinking. When companies owe billions in debt that's getting more expensive to service, the illusion cannot last forever. Debt doesn't disappear. It waits quietly until it becomes unbearable. Another red flag comes from margin debt. Money investors borrow to buy stocks. It rises in moments of dangerous confidence, when people believe the market will keep going up no matter what. Right now, margin levels show that retail investors are heavily leveraged, many betting with money they don't have, believing they won't lose because the market always recovers. But leverage is a double-edged sword. When stocks fall even a little, margin calls hit fast, forcing people to sell at the worst possible moment, accelerating the decline. Margin spirals are one of the fastest ways a calm market turns into a correction. And the signs of this spiral are already beginning to form. Buy now, pay later usage is another hidden indicator of strain that Wall Street ignores because it doesn't show up on balance sheets the same way traditional debt does. Households that cannot afford basic purchases today are using installment payments at record levels, and while this doesn't directly hit the stock market instantly, it signals something deeper. Consumers are running out of money. That means weaker earnings in the near future, weaker guidance from companies, and a weakening market foundation. When retail spending slows, corporate profits fall. When profits fall, stock prices follow. It's simple, yet Wall Street acts as if consumer exhaustion isn't a threat at all, even though it's one of the clearest signs of an upcoming correction. You also see troubling patterns in corporate layoffs. Companies announce job cuts at the same time their stock prices hit new highs, which makes no sense if the economy were truly strong. Layoffs are not a sign of health. They're survival moves. They tell the world that businesses are worried about future revenue and are preparing to shrink before they're forced to. Investors cheer layoffs because it makes short-term numbers look good, but long-term layoffs are flashing red lights. Fewer workers means slower output, slower growth, less innovation, and a weaker consumer base. A healthy economy doesn't celebrate job loss. Only a fragile one does. Even the bond market is sending warnings. Yields jump, then drop, then spike again. Patterns that signal confusion, instability, and fear. Bond markets tend to whisper truths long before stock markets scream them. And right now, bonds are whispering that something is wrong. The most dangerous part of all these red flags is how easy they are to ignore when stock prices continue rising. People forget that numbers can lie. Charts can mislead. Markets can mask reality. But cracks don't disappear because someone pretends not to see them. These hidden red flags, overvaluation, corporate debt, buybacks, margin leverage, layoffs, and consumer exhaustion, paint a picture not of strength, but of a system stretched to its limits. And when a market is this fragile, it doesn't take a disaster to break it. It takes one bad quarter, one missed projection, one shock, one spark, and then everything people ignored becomes impossible to escape. The truth is that the U.S. stock market cannot keep pretending forever, because the economic pressure building outside Wall Street is becoming too powerful, too widespread, and too painful to ignore. Every major correction in history has been triggered not by what happens on trading floors, but by what happens in the real world, in households, in small businesses, in spending patterns, in the day-to-day lives of ordinary Americans. And right now, the real world is screaming. Consumers are no longer spending like they used to, not because they don't want to, but because they simply can't. People who once had breathing room now check every receipt twice. Families who used to go out on weekends now stay home to save gas. Shoppers are putting items back, choosing cheaper brands, and waiting weeks before making even small purchases. That shift, from normal spending to survival spending, is always one of the earliest signs that an economic downturn is growing underneath the surface. And when consumer spending weakens, corporate earnings weaken right behind it. No matter how strong a market looks or how confident investors pretend to be, a country cannot cut spending this sharply without markets eventually feeling the weight. Small businesses are already feeling that weight in the harshest way. Across the country, independent shops, restaurants, service companies, and family-owned businesses are collapsing under high costs. Their rent is higher, their supplies cost more, their utilities are more expensive, their loans cost more to repay, and their customers have less money to spend. This combination is brutal, not in theory, but in daily reality. Every week, more small shops turn off their lights for the last time. Once they close, jobs disappear, neighborhoods lose their identity, and local economies weaken. This isn't just an emotional loss, it's an economic one. When small businesses fall, demand drops even further, and larger companies begin to feel the shock waves. Eventually, earnings reports start reflecting that pain. Corporate profits shrink. Guidance lowers. Stocks tumble. It always starts small, but it never stays small. Then, there's the pressure created by high interest rates. A silent, heavy force crushing households and businesses at the same time. When money becomes expensive to borrow, people stop taking loans. They stop buying cars. They stop upgrading their homes. They stop taking risks. Businesses stop expanding. They delay hiring. They freeze projects. They cut spending, trim budgets, and operate more cautiously. This kind of slowdown shows up slowly at first, then all at once, as companies begin reporting weaker results, missed targets, and disappointing forecasts. The market hates disappointment more than anything, and right now disappointment is coming from every direction. Higher debt, higher costs, slower spending, weaker demand. Interest rates don't just slow the economy, they choke it, squeezing the life out of every financial decision until confidence dries up. And confidence is the oxygen the stock market breathes. Another powerful force tightening around the economy is the credit environment. Banks are lending less freely, raising requirements, and approving fewer applications because they can see the financial strain hitting households. They see the rising number of late payments. They see the maxed-out credit cards. They see the shrinking savings accounts. They see the early warning signs before the public does. When banks get nervous, they close doors quietly, and those closed doors eventually suffocate the economy. Less borrowing means less spending. Less spending means weaker earnings. Weaker earnings drag stocks down. It's a chain reaction the market cannot escape, no matter how confident investors pretend to be. Meanwhile, everyday Americans are reaching their limits. Food costs more. Rent costs more. Car payments are at record highs. Insurance is up. Utilities are up. Interest is up. Stress is up. Savings are down. People are not spending because they're scared, not of losing money in the stock market, but of losing stability in their own lives. That fear fuels a pullback that Wall Street cannot afford to ignore, because eventually, the pressure at the bottom becomes pressure at the top, and what begins as a slow tightening in households ends with a sharp tightening in corporate balance sheets. The stock market may not feel the pain yet, but it is coming. The slowdown is already spreading. People are cutting back. Businesses are shrinking. Profits are weakening. Companies are moving cautiously. And the economy is quietly preparing for a correction that investors think they're safe from. But no market is safe from the reality outside its walls. And right now, reality is getting louder every day. What makes 2025 such a dangerous year for the U.S. stock market isn't one event, one headline, or one crisis. It's the way multiple pressure points are converging at the exact same time and creating the perfect conditions for a correction that has been building quietly for years. The warning signs are stacking themselves like dominoes, and all it will take is one small push for the entire line to fall. Companies across the country are already announcing layoffs in waves, not because they want to, but because they're preparing for what they see coming. These layoffs aren't random. They're strategic warnings. Businesses cut staff when they expect revenue to fall, when customer spending slows, or when internal forecasts indicate turbulence ahead. And right now, those cuts are hitting industries that were once considered stable: tech, retail, logistics, finance, media, manufacturing. Every announcement is a subtle confession that growth is slipping and that the numbers behind closed doors look far worse than the public knows. At the same time, earnings reports, the lifeblood of the stock market, are telling a story Wall Street doesn't want to admit. Companies are reporting profits, yes, but the growth is shrinking, the margins are tightening, and the forecasts for future quarters are quietly lowering. Executives talk in vague language about uncertain conditions, softening demand, or shifting consumer behavior, phrases that essentially mean one thing: people aren't spending like they used to, and businesses expect that slowdown to continue. Investors shrug it off because stock prices still rise for now, but earnings eventually force the truth into the open. Markets don't correct because people panic. They correct because the math finally catches up. And the math going into 2025 is looking worse every month. Behind the scenes, something even more telling is happening. Investors are moving their money into safer assets: bonds, treasuries, utilities, defensive sectors. Whenever you see this quiet shift, it means fear is entering the system long before the headlines notice it. This migration isn't loud. It doesn't trend on social media. But it's one of the most reliable indicators of a coming correction. Smart money leaves the risky parts of the market early, slowly, almost invisibly. And by the time the public realizes what's happening, the damage is already in motion. The stock market may still look strong, but the behavior of the people who truly understand the system says otherwise. Meanwhile, major debt bubbles are swelling beneath the surface. Auto loans, credit card balances, buy now, pay later debt, and even corporate liabilities. Americans are drowning in high-interest payments they can't keep up with. Cars are being repossessed at rates not seen since the last financial crisis. Credit card defaults are rising. Buy now, pay later. Companies are seeing a surge in late payments. Corporate debt is becoming more expensive to refinance. These bubbles don't burst with a bang. They deflate slowly, dragging consumer confidence down and squeezing business revenue. And once revenue drops, stock prices follow, because Wall Street cannot detach from Main Street forever. A correction doesn't start because of debt itself. It starts because debt becomes too heavy for consumers to carry. And 2025 is shaping up to be the year that pressure becomes unbearable. Even more dangerous is how one spark, a bad earnings season, a sudden jump in unemployment, a bank revealing losses, a geopolitical shock, or even a major company collapsing, can trigger a chain reaction in an already fragile environment. When confidence is thin, fear spreads quickly. A single red day in the market turns into a week. A week turns into a month. Investors start selling. Margin calls hit. Prices fall faster. And the correction that people said would never happen becomes the only thing anyone talks about. Every major market downturn has followed this exact script. Calm, denial, red flags, pressure, then a spark. And 2025 looks like the year where the spark finally finds the dry fuel that's been building quietly for a long time. All the ingredients are already in place. Slowing earnings, rising debt, layoffs, cautious spending, tighter credit, and nervous investors. The market can only ignore reality for so long before it is forced to confront it. And when that confrontation happens, the correction won't feel surprising. It will feel inevitable. Because the truth is, 2025 isn't just another year. It's the year when everything the market has been avoiding finally begins to catch up. If a major stock market correction hits, it won't feel like the dramatic crashes people imagine from movies. It will feel like something far slower, far quieter, and far more painful, a steady tightening that creeps into everyday life until people suddenly realize they've slipped into a place they never thought they'd be. A real correction doesn't happen in a single day. It unfolds across weeks and months, starting with tiny shifts that most people ignore. Stocks begin slipping a little bit at a time. A few red days turn into a red week. Investors shrug it off as normal volatility, but they start checking their portfolios more often. Financial news channels begin hinting at softness in the market, using gentle words to describe something that is already gaining momentum. And slowly, without panic at first, confidence fades. The market doesn't crash because people panic. People panic because the market has already started to fall apart underneath them. As the correction deepens, the impact spreads beyond the charts and into the lives of ordinary Americans. Retirement accounts lose value. Savings shrink. People who were once proud of their investment strategy begin quietly questioning every decision they made. Those who entered the market late, buying high because everyone around them said stocks were safe, feel the fear deepest. Every dip feels personal. Every red candle feels like a warning. And while investors feel the emotional weight, corporations feel the financial one. With stock prices declining, companies tighten budgets, freeze hiring, and begin preparing for a rougher future. Projects get canceled. Expansion plans get delayed. Raises disappear. The optimistic language of growth gets replaced by careful words like adjustment, transition, and restructuring. Those words almost always mean layoffs are coming. When layoffs begin, the correction spreads beyond Wall Street and becomes a national experience. Families wake up to news that a major company has cut thousands of jobs. Friends talk about updated resumes and interview stress. People who once felt secure suddenly worry about their next paycheck. This anxiety grows like a shadow across the country, and it changes how people behave. Spending slows even more. Restaurants get emptier. Stores see less traffic. Vacations get canceled. Families delay car purchases, home repairs, big-ticket items, anything that feels unnecessary in a moment of uncertainty. And as consumer spending drops, corporate earnings weaken even further. It becomes a cycle. Declining stock prices, weaker earnings, more layoffs, weaker spending, deeper correction. Each piece feeds the next. At the same time, banks tighten their lending even more. Credit becomes harder to get. Loan approvals drop. Interest rates stay high. Small businesses that desperately need cash to survive are turned away. Households get rejected for credit cards and personal loans they once easily qualified for. This tightening acts like a brake on the entire economy, slowing motion everywhere. And once the correction reaches this phase, the impact becomes unavoidable. It touches everyone: investors, workers, families, business owners, even people who never followed the market or cared about stocks at all. Housing will feel the shock next. Buyers disappear because confidence collapses alongside portfolios. Sellers panic as home values soften. Mortgage approvals shrink. Renters who dreamed of buying suddenly realize owning a home has drifted farther away than ever. The real estate market enters a frozen state. Not a crash, but a suffocating stillness where no one moves, no one risks, no one decides. And all the while, the correction continues its slow, downward pull. The hardest part of a stock market correction isn't the numbers, it's the emotional impact, the feeling of losing control, the fear of what comes next, the uncertainty about jobs, bills, savings, and the future. Ordinary Americans feel the weight long before the media calls it a crisis. Parents start worrying about school costs. Workers rethink their plans. Retirees quietly cut expenses. Young people question whether the system will ever work for them. The correction becomes more than financial. It becomes psychological. And while the wealthiest Americans move their money early, diversify their assets, and protect themselves with information and resources the average person doesn't have, the middle class absorbs the punch. They are the ones who lose savings, lose jobs, lose time, lose confidence. They are the ones who get hit hardest by a system that celebrates them during upturns and abandons them during downturns. A correction doesn't just hurt their finances, it reshapes their lives. But buried inside every correction is a truth most people don't see immediately. It exposes what was broken long before the fall. It reveals weaknesses in companies, in debt systems, in spending habits, in policies, in banks, in expectations. The correction itself is not the cause. It's the consequence, a reflection of pressure that was building long before the charts turned red. And when the dust finally settles, people look back and realize the signs were always there. The slowdown was always coming. The imbalance was always unsustainable. The correction was not sudden. It was inevitable. And for millions of Americans living through it, the real story isn't the market crashing. It's the moment they realize the system was breaking long before the first stock ever fell.